Hey everybody, welcome. Glad to have you with us in this video. This is going to be a little bit different than my previous videos and most of the videos that I'll be doing on this channel. This is just kind of a general market update, and you're going to get kind of raw. I'm just going to kind of walk you through the charts and what I see for the market, for the current date, and where we stand. And these are just kind of my raw ideas and thoughts on where we're headed, where we might be headed, and where we've been. Just a general disclaimer, this is not investment advice. This is not any sort of way for me to induce you to trade a certain way or to make any sort of decisions into your portfolio. This is none of that. This is just kind of my raw take on where we're at. I would not encourage you to use any of this information to make any personal decisions without consulting a financial advisor, and take this advice for what it's worth and what you pay for it. So just have to say that out the front. So let's take a look at where we're at. So I'm recording this on February 27th. So we're in the final weekend of February. The month is completed as far as the trading days go. And I want to kind of look at the monthly candles and where we're winding up for the second month of 2021. So I'm going to change my setting here so you can kind of see my charts, and I'll just walk you through this process. So hopefully everybody can see this. All right, so let me kind of give you an overview of what we're going to talk about today. So we're going to look at candle patterns in 3 different index stocks to kind of give us a glimpse of where we're at in the market. Okay, so what's a candlestick pattern? Candlestick is something that's meant to represent the 4 most important pieces of data in any time period for a market, a stock, an ETF, a fund, a mutual fund, any sort of financial service that you want to be able to track. You can use candlestick patterns, and they're very, very useful. All right, so what do we have? You can see all these little, what we would call candles along my chart here. And a candle, let's take this one right here. This is representing, all candles represent, like I said, the 4 most important points of data, which is the opening price, the closing price, and then that time period's intraday or week or minute high and intra time period low. Okay, so those are the 4 most important pieces to remember. So I mentioned this is the end of the month, so we're going to be looking at monthly candles. So this is going to encompass the entire month. Let me start here at the top right. You can see I'm on the ticker SPY. This is probably the most important ticker in the entire market because SPY is an ETF that tracks the S&P 500. So this is kind of our benchmark, which most of your investments are going to get measured against. What was the performance of the Standard & Poor 500 largest stocks in the U.S. stock market? Okay, that's what the S&P 500 is. This is kind of how you know how good or how bad the overall market is doing. So SPY, as we look at the February candle, this is a green candle. That means that for the month of February, SPY, or the S&P 500, closed higher than it opened. Okay, so the price, you can see this filled in part, this, we call this the body of the candle. That's representing the open to the close price. So if it's green, like I said, that means it closed higher. So the bottom of this candle, the body of this candle, is kind of 373.72 is what the month of February opened, the price. It closed at 380.36. So that was a green month. That's not the whole story. You can see what we would call the wick of this candle, and that's this thin line on top and bottom. So in the month of February, it got down a little bit lower than what it opened. So it went all the way down to 371.42, and then it got as high, which happened to be an all-time high, of 394.17. Okay, so what candlestick patterns can do is really kind of give us a clue. It tells more of the story, not just, I'm going to switch over here for a second if I can figure out how to do it, away from a candle chart. Let's see. I haven't done this in a while. Here we go. I usually always look at candles. You might have seen this before. This is a line chart, and this is, good and somewhat useful because you can kind of see the overall trajectory of this index. We go up, we go down, we go up, we go down, back up, and so on and so forth. Those are called wave patterns. And it kind of gives you an indicator of where we're going. But look at this. All you can see right here is, okay, we went up for the month of February, but that's all you know. You don't know any other data besides the fact that it closed higher than it opened. And that's important to know. But when we go back over to candlesticks, it tells more of a complete picture. Okay, so what picture is it telling us? The shapes of these candles can sometimes be a good indicator of what's to come. Doesn't guarantee it, but again, we can just deduce patterns from this. So you can see here the month of February had a relatively small body of the candle. Again, that's the colored in part, and a decently tall wick on top and a short little wick on bottom. What does that mean? That means we had a rally in the month of February. What's up, Grant? Sorry. We had a rally in the month of February all the way up to an all-time high of 394.17 before retreating down and closing higher for the month, but not really that close to our all-time high. As opposed to, let's take a few months back and we look at the month of November of 2020. This is a much stronger green, or we would call bullish candle, which means we opened all the way down here at 329 and closed at 361. That's a very strong month. This indicates some tension in the market. And if you were paying attention, this past week, the final week of February, was a pretty volatile one where we saw some decent selling. What was the reason for that? Lots of reasons. There's always multiple reasons for a market to sell off or to rally. I would say the primary driver of this is twofold. Number one, we saw the first spike of interest rates in a while. So bonds were starting to tick up. The 30-year rate on bonds was moving up and a pretty quick little clip for the first time in a while, like I mentioned. And so why is that significant? That actually caused the equities, the stock market, to retreat a bit. The reason for that is, for the longest time, we've been dealing with very low to virtually non-existent interest rates. And so in that type of environment, equities are always going to do well because, especially growth stocks. So growth stocks are able to borrow more money for cheap to continue to grow their company. These are the tech and the innovation stocks that are going to be pouring more and more of their capital into expansion. And so when they can borrow money cheaply, it causes them to grow faster. So those growth stocks are going to do well in low interest environments. The other reason is that there's simply, when bond prices and interest rates are in the basement, they are not attractive. So they're really not an investment you want to be in. So the only other option for most people are stocks. So when interest rates are in the basement, you're going to be risk on to be into the market because you do not want to put your money in bonds that are paying nothing. So as bond interest rates are starting to tick up a little bit, there are now becoming more options to put your money into. So that's a reason for the sell-off. That's number one. Number two reason for the sell-off is honestly because we've been looking and waiting for a pullback. And so sometimes when everybody is waiting and anticipating that the market is going to pull back or correct, it will take any excuse it can get, and interest rates were a good excuse for it. So it's a little bit of a self-fulfilling prophecy in that we were waiting for it, and so it happened. So pullbacks are very normal. You can see they happen quite regularly. There was one, the most recent one. I mean, you can kind of call January a little bit of a pullback. It was slightly red. February had somewhat of a pullback. even though it was green. The more significant pullback, the last one we had, was from the end of August of 2020 to the beginning of November of 2020. You can see we ended this monthly candle, August 31st, up here at 349, came all the way down, was kind of volatile in the month of September, closed lower, a little less volatile in October, but still closed a little bit lower. And then we rallied in November and kind of broke through to new all-time highs. So that's a very healthy, normal pattern. Let's go back a little bit. Everybody remembers this. So what happened March of last year when we found out we had COVID? I would say we more than corrected. We crashed for a couple months. So back in January, you can kind of see we had some indecision here, not a whole lot of market movement. And then February, we really started to sell off. But hey, this still looks like this sell-off. Pretty healthy, pretty normal. And then March, the bottom just drops out with all the restrictions, lockdowns, and the whole world changing. So we got down quite a bit. I mean, look at this move. We were at a, back then, all-time high of 338. And then in a month, we crashed all the way down to 218. That's a massive move in a very short amount of time. But bounced very quickly back from that and recovered in just a few months. So these are patterns that happen all the time in the stock market. Okay, so let's talk about why do we care about any of this? Well, we can again use candlestick patterns to kind of decide and determine where we've been and where we might be going. So I mentioned the month of February was volatile, and we closed green on SPY, again the S&P 500, but not that much. Okay, so what does this tell us? When you have a large top wick like this and a small body, you had a rally in the month, like I said, and then a retreat from that rally. So this can indicate potentially a very short-term top, and we might see more selling in March before we ultimately bottom out and take off again. But because we did close green, it's not like a real scary candle. So we could consolidate for a while, which basically means we go sideways. So we might see another candle like this in March, where we maybe go red or maybe we come up a little bit. The real key is going to be what happens in the price action. So if we don't eclipse this all-time high of 394 and the S&P 500, we'll probably consolidate or continue to retreat a little bit. But if we have a strong month where we eclipse this all-time high, then we could very well continue our move upward. Anything's possible. One important thing to look at is what are called moving averages. And that are these colored lines that you see below the price right here. Moving averages is the average price over a longer period of time, so you can kind of average out what the movement of the stock is doing. So I have 4 different time periods here. The purple line represents the 20 moving average. The blue represents the 50 moving average. The yellow represents the 100, and the red represents the 200. And this moving average changes based on the time period. I'm looking at monthly candles, so this 20 indicates this is the average of the previous 20 months of price. So we are well above that. We're well above all of them. The 50 represents the 50-month average, the 100-month average, and then the very long-term 200-month average. Let me zoom out and show you how these moving averages give us clues as our stock price moves. So this is quite zoomed out. Okay, see how we have this dip down here? This is all the way back to 2008, 2009, long time ago when we had the financial crisis, the housing issues, and the bank collapses. So that was a pretty heavy recession. That was called the Great Recession. It was considered one of the worst times for the market since the Great Depression. Okay, so from that bottom in this recovery, we can kind of see what has happened with these moving averages as they go along. Okay, so we have our initial bottom and recovery, from 2009 onward. And we're kind of dancing around here. I want you to pay close attention to this 200 moving average. This is historically for any stock and for any mutual fund or index, strong support. So you can notice how it acted as support in 2010 when we tried to correct and dip a little bit. It would not break underneath that. We rally some more into 2011, and then in the end of 2011, we try to retest that again and break down. We do. 200 holds a support. We rally from there. We continue this wave pattern up and down. And then we see a very strong move from 2011 all the way to 2015. Pretty much a straight line with very little corrections and sell-offs in between. So, this is great. The economy's booming. We're doing well. And now we start to consolidate. Okay, so we don't really go anywhere for several months, and then we see all of a sudden a big red candle right here. This is in 2015. I don't know. Someone could probably help me with what was happening historically here, but I'm guessing we had some news or some things happening. Maybe a government shutdown. I'm not really sure. But you can see we had our first significant drop. Okay, look at this candle. This started out high, closed right below the 20-month moving average, which is an important kind of short-term indicator. But we have a long bottom wick. So this price got all the way down in between the 20 and the 50, but kind of came up to close near that support. Okay, that's a pretty strong indication that this market was not going to crash, but we were in the midst of a correction. Okay, because it held this as support. If it wouldn't have held this support and just kept going down, 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 then we would have been looking for support off the 50. But what happened here? We kind of had some indecision month of September. This is called the doji candle, where you have a very small body in the middle and a tall top wick and bottom wick. That's an indecision candle. It could either reverse or continue its momentum. We had a strong bounce back the next month, but look, it didn't eclipse these highs, so we still were kind of in an inside range here. We didn't know where we were going. Another doji month, doji candle, indecision, and we kind of retreat, but again, hold the 20 as support. Next month, we break that support. So here's where you could kind of say maybe we're in trouble. This could have, we had a new low. This is going back to support the low from way back in October of 2014, and here we are in January of 2016. So this is why it's really important and useful to look back quite a ways to see where your supports and resistances are. So again, we have a not great looking candle, but again, a long bottom wick. So we've recovered a decent bit of what we sold off. And then we have another doji with some indecision, and finally a break back above the 20-month moving average. So this indicates how this 20, even though we're dancing around it, acted as short-term support for this price action. And then we finally recover and get ourselves firmly above it. And then we have a nice, massive rally. Okay, what was happening here? Here was the election of 2016, and we have a new administration. Look forward to much more favorable economic policies for markets. And we had the beginnings of the Trump rally. So here's the Trump rally all the way up, and then we end with a blow-off top in the beginning of 2018 with exuberance, and then we settle back and kind of retreat back down and sell off, okay? But look, 20 is still holding, and then we have kind of a rally through the summer, and then another sell-off. This is when the market starts to get spooked out with interest rates. Jerome Powell came on and said, we are going to have to raise rates and be flexible in our policy to unwind the balance sheet and to try to manage this risk of inflation. Markets didn't like that, so we sold off, held the 20, had kind of an indecision month, and then we broke the 20. But look right where the bottom wick is of December of 2018. I remember this feeling. Everybody was pretty panicked about what was happening with the market. We actually I believe we hit this low on Christmas Eve of 2018. But look what supported. The 50. Okay, so the 50-month average supported. We rallied back the end of the year to close right in between the 20 and the 50. Had a little bit of a gap down and start January, the new year, and then we had a strong rally right back to that 20. Okay, so it's 20 ultimately held as support with 50 holding as stronger support. Okay, and then we continue to move up. This, I believe, was some trade war risk. and concerns. We came back to the 20, held the support, came back up, broke out of a kind of a long-term, this is kind of our lid right here for the entire month of 2018 and 2019. Then we broke through and reached new all-time high, and then we had COVID. Okay, so COVID took everybody by surprise, but what should not have taken us by surprise is a potential sell-off in the market. Here's why. Candlestick patterns. Because what happened in January of 2020, we had just broken out and had some strong months. Look, we had a 2.5% gain, 3.5% gain, 2.5% gain to close the year of 2019. So that's a pretty strong year. So January, a lot of times is taking some profit, enjoying what happened the previous year. So we're going to see some selling, and this is a really clear indication of things might be changing because you have a red candle that has a long top wick and a small little body here. So if I were taking bets, I would bet that the month of February of 2020 would have sold off. Now, I would have just guessed that we would have gone back maybe to the 20, or we would have gone and retested this previous resistance, this high back here at about 294, and then continued our trek on upward. But what happened? Well, that pretty much happened for February, and I would bet if we did not lock down and have COVID change everything, that likely would have been what happened there. We would have continued our march upward. But March is when the fear sets in, and we dump. Okay, so what happens? We break straight through that 20. We break through the 50. This was like 3 weeks that this all happened. We broke straight through the 50. So, oh my goodness, fear is in. We are selling. What's happening? But again, look where we found support, right at the 100-month moving average, 218.26. That was our bottom. You never know it at the time, but it was. Again, if you were trading this, you could have made a bet that this is going to hold as support. We rally all the way back from there and close as monthly support on the 50-month moving average. And then in April, as we really start to kind of take stock of what actually happened and how we're going to move forward and what life is going to look like and work from home and all that stuff, we had a wonderful bounce back of about 12% all the way back up to this 20-month moving average. Okay, so these moving averages are like magnets. The candles want to be there. Okay, and the longer a candle is away from one of these moving averages, usually the more violent the move back to those averages happen. So I say all that to say, where are we now? We're right here. We could very well continue to rally up. I think that this concern over the interest rates are a short-term concern and nothing to worry about in the long term, because honestly, we want interest rates to go back up eventually. If our economy is working and strong, we should have stronger interest rates, because otherwise we are going to have a hard time battling against inflation, especially with all the continual expansion of economic policy and fiscal policy, where we are stimulating the economy with borrowed money and inflated budgets. At some point, we are going to need interest rates to rise. So I don't think it's a negative for the market long term. It's just making everybody check a little bit and say, okay, maybe I reassess what I'm exposed to and how much I'm in heavy into equities. So it's been a while since we've touched the 20. It may be a few more months, it may be another year or two, but I bet we are coming back to this at some point. But that could be at a point in the future where this 20-month is a lot higher. So we'll see what happens in March and the subsequent months, but I would not be shocked to see a little bit more of a sell-off, a little bit more of a retreat down, maybe some consolidation. Maybe we let these averages kind of continue to curl back up and get a little closer to our current price before we continue. But we are, most people agree we're still in a secular bull market, which means we are not in a bear market. This was a very short bear market, if you even want to call it that, or potentially just a pretty massive correction within the overall bull market that we have seen since 2009. So that's what I see. I don't know if this was helpful for you or not, but Hopefully it was, and hopefully maybe you learned something new that you didn't know previously. I'm going to do this monthly to kind of give you my take on where we're at. If you have any questions about this, let me know. Any thoughts? What are you thinking we're doing? It's just a good time to take stock of where your portfolio's at. Make sure that you are comfortable with the investments you're in. If you're not, you should be working with a professional. Let me know if I can help you with that. I'd love to reach out and have an initial conversation about where you're at in your retirement savings. Make sure you're on a good path and not just investing your money because you know you should, but really understand why you were invested in the way you are. That way, when 2020 happens and the market crashes 30%, you don't have to worry about it because you understand what you're in and there's a strategy. So I hope this was helpful. I'll be back at the end of next month to look at that monthly candlestick pattern. And I might even do these live. So that way, if anybody wants to jump on and ask questions live and look at charts in real time, we could do that. And yeah, ask any questions so I can answer them next time. And I'll see you in March.